Hey, hello everyone. Thanks for joining in today. Uh, I'm Naveen from Windmill Capital. We are a subsidiary of Small Case Technologies. Today, I just want to discuss with you how small caps works. What exactly are small caps? Why do they behave the way they do? What has generally been the behavior of small caps in Indian markets over the last decade or so? How do they behave under extreme circumstances? Given the sort of rally that we've been seeing in the Indian stock markets recently, is it a good time to enter small caps or buy into small caps? And what are some of the offerings that we have from Windmill Capital? So to kick off the session, so I have been working with small case and Windmill Capital for about 15 years now, for about 8 years now, and all in all, I have over 15 years of work experience in the financial services domain. I started working with my career with Thomson Reuters, and subsequently moved on to a small case and then Windmill Capital. I have an MBA from National University of Singapore. So now moving on to today's agenda. Let's start with what is why is it that there are a lot of focus on small cap stocks? What exactly does small cap premium mean? How does it work, and why does it work? So SEBI has put out a standard definition of what small caps means. Uh, till recently, we did not have a standardized definition of what small cap companies were. Some people used to say that any company below 5,000 crore market cap would be called small cap. Others would say anything below 10,000 crore as market capitalization would be considered as small cap. And in terms of packaging, whether it was mutual funds or PMS products and stuff like that, different managers would use different benchmarks to call their companies small cap. So in order to eliminate all of this, confusion that used to be caused, SEBI has come up with a standardized definition. So what they do is first they calculate the average market capitalization of all the companies listed in India over the previous 6 months, and they then rank it on the basis of market capitalization. So any company which has a market cap rank greater than 250 is always considered to be small cap. The top 100 are large caps, 101 to 250 is mid cap, and then 251 onwards is small cap companies. So obviously 500 companies over there, usually about 250 companies are small cap companies, and the rest are mid and large cap companies. So now on to the question of, what is a small cap factor, or what is a size premium, and why does it work? So when you look at investing in stock markets, usually any investment manager will talk about investing based on certain factors. Now, what is a factor? A factor is a broad and persistent driver of stock return. So one of the factors that usually everybody talks about without even understanding that it is a factor is the valuation of a company, right? Everybody talks about how a quality company that is trading at a low PE is a good investment bet. Very similarly, growth could be another factor, right? A company that is growing fast, one is advised to invest in companies that are growing fast. Very similarly, just like how valuation is a factor, how growth is a factor, size premium is also a factor. And this size premium, wherein small cap companies tend to provide greater returns compared to large cap companies over long periods of time. This has been absorbed in different stock markets across the world. It's not just in India. Extensive research has been done regarding this size premium. And this is a factor that has been absorbed in different markets across the world. So what allows, on an average, why do small cap companies over long periods of time do better than large cap ones? One is obviously the question of market efficiency. In small cap companies, there is not too much of information available online about these companies. There are not too many analysts tracking these companies. So there is a lot of inefficiency versus the price. When there is not a lot of information, not a lot of people tend to track it. So there is possibility there is inefficiency in terms of understanding the company. And when some people dig a little and get a good grip on the company, the price of such stocks tends to run up. Second is the question of growth potential. Now, it is obvious that a small company can grow at a faster pace when compared to a larger company. Imagine two companies in the IT sector, right? There is a small company X, which is working in, let's assume, artificial intelligence, versus a large company like a TCS or Infosys, right? Now, a large company has stable cash flows, and there are like, it has access to big customers and stuff like that. But because it is very large, it will not be able to let's say consistently grow at 20-25% returns in terms of sales and EPS growth. Whereas a small company which is possibly working at the cutting edge of technology might be able to do it and garner a very high market share in its niche. So this growth potential is another factor which sort of leads to on an average small cap companies performing better than large cap ones. Third factor obviously is the investor behavior, right? Now, because there is a lot of inefficiency as compared to inefficiency in small cap stocks as compared to large cap ones, and not a lot of things are known about these small cap companies, and they don't have stable business models and the likes. They tend to be, the prices of such stocks tend to be a little volatile, which is why a lot of investors who are risk averse tend to stay away from such companies and don't really seek to invest in such companies. This investor behavior also sort of contributes to small cap companies being undervalued, and when they get discovered, when people understand that there is a lot of quality behind this undervaluation, their price tends to run higher, which is why the potential of earning greater returns in small cap companies is higher when compared to that of large cap companies. Now, I hope that sort of clarifies what is factor investing and what is size premium and why that size premium comes about. Now, let's move on to understand how small cap companies have been performing in India over the last couple of decades. Now, in this chart, I have tried to plot the performance of Nifty 100 versus Nifty Small Cap 100. The red line represents Nifty 100 and the white line represents Nifty Small Cap 100. Now, one thing that you can see is there are large places where the white line tends to go below and above, the red line, which is the Nifty 100 line. So you can see that during 2008, 2009, when there was a global financial crisis, the Nifty Small Cap 100 dropped steeply when compared to Nifty 100. It's not that the Nifty 100 did not drop, but the drop of Nifty Small Cap was significantly higher. Very similarly, when the market, made a comeback in 2009 and 10 onwards, the Nifty Small Cap recovered or returned higher money as well to shareholders. You can consistently see this behavior across, till very recently, till 2023 as well. So obviously, you can see that in 2008 and 2009. Subsequently, in 2013 also, you can see that when the markets, when Nifty Small Cap was flat, when Nifty 100 was flat, Nifty Small Cap was trading in the negative territory. Subsequently, when Nifty 100 recovered, the recovery of Nifty Small Cap 100 was much steeper. You can see that here in during COVID times as well, when Nifty 100 fell in between Jan and July, the fall of Nifty Small Cap was much steeper. And very similarly, during the subsequent recovery phase as well, the rise was much higher. And then the subsequent fall during the Russia-Ukraine crisis also, the fall was much steeper. So this is what happens. The volatility of Nifty Small Cap 100 tends to be significantly higher than that of the large cap stocks, which is, like I told you, it is one of the reasons why not a lot of people prefer to invest in small cap companies. You can see this volatility, analyzed volatility that I have pulled up for Nifty 100 and Nifty Small Cap. So this tells you, once again, you can see that consistently between, let's say, 2013 till 2020, for almost 7 years, the volatility of Nifty Small Cap 100 was significantly higher than Nifty 100. And during times of spike as well, the spike usually tended to be higher, and then that persistence is there in behavior, right? Even when it is dropping, the volatility is slightly higher when compared to Nifty 100. So this is one of the reasons why investors tend to stay away, is what we're talking about. Now, let's take a look at how both these indices, that is the small cap index and the large cap index, tend to perform during extreme market conditions. Now, extreme market conditions it refers to both market uptrends as well as downtrends. Now, one of the first instances of extreme market condition is, let's start off with market uptrend. One of the first instances of extreme market conditions that we see are recovery after the global financial crisis in 2009 and 2010. So this recovery phase lasted for almost more than a year, between August 2009 and November 2010. So during this recovery phase, you can see that Nifty 100 ran up by about 37%. This is absolute returns that I'm talking about, whereas Nifty Small Cap 100 ran up 54%. Subsequently, during US Fed's quantitative easing program as well, which lasted for close to 3 years between 2012 and 2015, the Nifty 100 returned 61%, whereas Nifty Small Cap returned 67%. In India, when there was government reforms and global economic growth during NDA 1 or BJP 1's government between September 2016 and August 2018, the returns were slightly different here. Nifty 100 was 33% and Nifty Small Cap 25%. But subsequently, during the post-COVID pickup time, the performance sort of went back to its historical levels, which is Nifty 100 was up 56%, whereas the small cap doubled to, and ended up giving more than 100% returns. During the most recent phase as well, which is March 23, the recovery that we've been seeing since March 23, you can see the same thing. Nifty 100, I'm pulling up data as of, end of November. But the Nifty 100 returns has been close to 20%. Add a few, basis points returns here, considering the rally since then. And Nifty Small Cap 100 has grown up about 61%, right? Now, what happens during downtrends, market downtrends? So during the global financial crisis that I was talking about, you can see that Nifty Small Cap 100 fell much, steeply when compared to Nifty 100. Very similarly, during COVID crisis, also the fall was higher. Nifty 100 dropped by only by about 12%, whereas Nifty Small Cap dropped by about 22%. Similarly, during the most recent Russia-Ukraine crisis, when since February 22 and March 23, when the markets were pretty flat, Nifty 100 dropped by about 4.3%, which is almost a flattish performance, whereas Nifty Small Cap was down close to 18%. So this is the performance that one can expect going forward as well. During downtrends, Nifty small cap stocks usually tend to witness steeper fall, but during times of market uptrends, small cap stocks tend to rise high as well. Now, let's coming on to the most recent performance. As I told you, I have data till end of November. So what happened? What is sort of leading to this initial flattish performance and subsequent raise in markets? Between Feb 2022 to March 2023, when Russia started sort of attacking Ukraine, or however you want to see it politically, the Nifty 100 was flattish for close to 1 year, right? Between Feb 2022 to March 2023, Nifty 100 was flat and stayed at about gave returns of about 4.3%, whereas Nifty Small Cap 100 dropped by about 18%. Subsequently, as the war continues over there, and we've been seeing some tension in the Middle East as well, India is seen to be one of the few places where there is a lot of growth happening, right? And because of this story, the markets have since started recovering. That is since March 23 till even today, mid-December, we have seen that Nifty 100 has risen by about 20% plus another, let's say 7 or 8% that it has gone up now. Comparatively, the Nifty Small Cap 100 has been up 61%. Now, one question that everybody tends to ask in such when the market rises up very quickly in such a short span of time is, what is happening? Is this rise expected to continue? These questions are very natural. Now, let's look at what is happening to the valuations. The first set, that is the 22.9 and the 22.5, refers to the valuation of Nifty 100, the PE ratio of Nifty 100, whereas the 27.5 and 26.4 valuation refers to the PE ratio of Nifty Small Cap. Now, the current PE ratio of Nifty 100 is about 22.23, close to 23 times its earnings potential, whereas the historical average, now, when I'm talking about historical average, I'm talking about data since Jan 2010. Since the historical average has been about 22.5x, right? So that indicates that in spite of this 19% jump, 19% plus probably another 7-8% jump, the valuations have not gone haywire, right? And the reason for that is because of this large flattish performance that we saw over here, and then this subsequent sudden raise. So while it might seem that the market has run up a lot, the valuations have actually not run up a lot, and they've been in line with their historical average. The exact same pattern can be seen in small cap stocks also, right? The historical average for Nifty small cap 100 is about 26.4, and the latest valuation is about 27.5, which is not too much of a deviation, right? So if you're asking yourselves this question that, small cap stocks have run up a lot, is it the wisest time to invest in such companies and stuff like that? This valuation should sort of give you a lot of comfort in terms of where you're standing in terms of historical average. And we can see that the current valuation of Nifty small cap 100 or this universe of small cap stocks is not too different when compared to its historical average. So I think we are fairly valued. That is on the valuation side. Now, on the growth side also, there are not too many bad news. There's not too much of bad news coming out for Indian companies. The festival season has been quite good. We've seen a lot of pickup in terms of, discretionary product, pickup in demand for discretionary as well as durable products. There's been fair amount of pickup in demand for cars and passenger vehicles. Two-wheeler companies, which have sort of been going through a funk for like fairly long period of time, have also seen their performance improving. So while rural demand has not completely, recovered, I think we are seeing a lot of improvement in demand coming through. Alongside, what is happening is commodity costs, which had eaten into the margins of a lot of companies, on the consumer discretionary and consumer durable side. Those commodity costs have also been going down. So overall, I think in terms of economic performance, we are in a very good space where slowly urban demand has been continuing. There's been general increase in demand from urban areas, whereas the demand also, there are some green shoots that are visible, and this was seen in demand for consumer goods and other fast moving economic indicators during the festival season. Inflation has started to trend low, which means people now have more money in their pockets. Commodity prices have started to become lower, which means margins for companies are improving, and we've started seeing some amount of growth coming back. So this, I think, sort of covers both the valuation aspect of small cap companies as well as the growth aspect, right? Now, let's move on to what are the small cap focused small cases that Windmill Capital has to offer. Let's start by checking out Quality Small Cap Smart Beta. Now, Quality Small Cap Smart Beta, what it does is it selects only small cap stocks that have been witnessing momentum. Now, one aspect that comes about when you're looking at small cap stocks that witness momentum is there could be a lot of volatility because there is some hot tip around that particular stock. There is some small growth aspect coming through and stuff like that, which is why it is very important to weed out such companies which are simply seeing momentum and only select those companies which will adhere to some sort of quality metric. Which is why what we did was internally, Windmill Capital has developed a quality rank based on which we rank all companies, listed on NSE on a certain quality parameter. Then we select only companies which have the highest quality, and then we select within that particular basket, we select stocks which are witnessing momentum. So the first company that I would talk about is Quality Small Cap Smart Beta. That is how, and this is how we are sort of putting this small case together. We are creating a quality metric. We are ranking all the companies listed on NSE based on that quality metric. We are only selecting the top quality companies, and within that selected basket, we are picking up companies that have been witnessing positive price momentum. The minimum investment amount for this basket is close to 19,800 rupees, and investors can get access to this for about 3,000 by paying 3,000 rupees per month. So some of the special features or characteristics of this particular small cases, it is small cap focused exclusively. We always pick up only small cap companies into this basket. And the factors that we are trying to give you access to is, one is the size. I have already discussed the size premium with you. So size premium always refers to small cap companies on an average performing better than large cap ones. So one factor that you're getting exposure to is size. The next factor that you're getting exposure to is quality. It is important to make sure that you're not just investing in small cap companies, but you're investing in quality small cap companies. So that is where the quality aspect comes in. And the third factor that you are looking at is the momentum aspect of it, right? It is not just small cap companies, it is not just quality small cap companies, but you are investing in quality small cap companies whose stocks have been witnessing price momentum. That is, they have been trending higher than the price of comparable index, right? Because there is a momentum aspect to it, this particular basket tends to be slightly heavy on the volatility side. So it's a high volatile basket. So if investors who are interested in investing in it should look to hold it for a long period of time. Now, what is a long period of time? Typically, when it comes to small cap stocks, I would say a long period of time is anywhere between 4 to 7 years, right? Don't invest in this particular basket if your time period is anything less than 4 years. You should give, to get meaningful returns, you should hold it over a longer period of time. Next, after the quality small cap smart beta, we have the value and momentum small case. Now, what does value and momentum do? It's like pretty self-explanatory. Here we are looking at value stocks, which means stocks whose PE ratio is on the lower side, but whose prices have started witnessing momentum. So there is a lot of headspace available for the prices of these stocks to run up because their PE is on the lower side, right? So obviously the factors that you get access to over here is valuation and then momentum. The minimum investment amount for this basket is slightly on the higher side. It is close to 79,000 rupees. And just like quality small cap smart beta, you can get access to this basket for about 3,000 rupees for a 3-month subscription, right? Now, when it comes to quality small cap smart beta, we are always looking to select only small cap companies. But with value and momentum, we are not going in with the idea that we will only pick up small cap companies. But because of the way the screening criteria, the filtering criteria has been set up, which is like, low PE stocks witnessing momentum, the small case tends to be mid and small cap heavy. So, which means there is a lot of self-selection of mid and small cap stocks into this particular basket. Because there is a lot of mid and small cap stocks, the volatility, the price performance of the small case tends to be on the higher side. So you can expect high volatility for long periods of time. And the holding period of the small case is also of long-term holding period. You shouldn't go in with the short-term mindset at all into this basket. And this has been one of the best performing small cases since it has been launched in 2017 and especially over the last 1 year. Now, moving on, we have the dividend star small cases. Now, when investing in stocks, capital gains is one way of making money, right? Another way of making money is by investing in companies which have a consistent history of paying dividends. So in order to facilitate that, what we have done is we have created the dividend star small case. So dividend star small case, the criteria is that we try to shortlist companies that have a track record of consistently paying dividends and consistently increasing the dividend payout as well. So not only are these companies consistently paying dividends over the last 4 or 5 years time period, but they have also consistently increased the dividend payout, right? These are two aspects. And then the dividend yield of this particular small case, the average historical dividend yield should at least be 2%. That is, investors on an average would have gotten 2% returns just via dividend yields, and even without considering the capital appreciation aspect of it at all. So this is the dividend star small case. So the factors that you would get access to is the income stream or the dividend aspect of it, and then the small cap aspect of it. So the natural question that comes up is where is the small cap angle to it coming? Once again, just like in case of value and momentum, there is a lot of self-selection of small cap companies into this basket because of the way the criteria has been set up. We are looking at companies who have been consistently paying dividends, which means these companies have been consistently making profits. And then there is a growth aspect to the dividend, right? Which means not only have they consistently been making profits, but they've also been growing. Now, the third aspect that comes into question is the dividend yield aspect of it, right? We are looking at companies which have paid at least 2%, whose dividend yield over the last 5 years on an average is at least 2%, which means there is not a lot of price discovery that has come through. Because of this average dividend yield angle, a lot of small cap companies tend to get self-selected into the basket. So usually what we have seen as far as dividend star small case is concerned is there is a concentration of large and small cap stocks. So usually it is in the range of 30% large caps and 70% small caps, or 20% large caps and 80% small caps, and so on and so forth, right? Once again, because there is a lot of small cap companies, it tends to be volatile, and the holding period has to be medium to long term. And the minimum investment amount is about 62,000 rupees, 62,688 as of the most recent date. This is slightly cheaper, priced slightly cheaper. You can get access to it by paying 2,000 rupees for a 3-month subscription. Next, we have CanSlim small case. Now, CanSlim is something a lot of people would have heard of. This is based on the CanSlim investment criteria. We have sort of tweaked it to ensure that it works well in Indian market conditions. So essentially, the CanSlim small case consists of efficiently managed growing companies. Now, when it comes to efficiency, how does one manage efficiency? A simple way of looking at efficiency is the return on capital that the company has been making. So as far as this basket is concerned, we only take companies who have a high ROE, that have been growing, and where there is a lot of positive price momentum. So some of the factors that you will get access to is, one is the quality aspect, because it is an efficiently managed company, which means there is a lot of high quality in it. Then it has to be growing. That is, the earnings per share, the dividends per share, all of these aspects should be growing for the company, which means there is a growth aspect to it. Third, the stock price has to be witnessing positive momentum. So there is the momentum aspect to it. Once again, because of the way the criteria has been set up, there is a lot of selection of small cap companies. So which means, like, once again, performance volatility will be on the higher side, and the holding period also has to be long term, right? And the minimum investment amount for this small case is about 62,500 rupees. And this is priced on par with value and momentum and quality small cap smart beta at about 3,000 rupees for a 3-month subscription. Now, apart from these sort of model small cases, we also have a couple of other small cases which are not just looking at small cap companies. One of them is the low risk smart beta small case. This essentially consists of large cap stocks that have low volatile large cap stocks. So if you want exposure to stock market, but you are a little risk averse, and even within the large cap group, you're looking at a risk averse bunch of stocks, low risk smart beta is definitely a small case that you should be exploring. We specifically look for large cap companies that have exhibited low price volatility over the last 1 year, which is why obviously the volatility is going to be on the lower side. The annual subscription fees for the small case is about 4,500 rupees. Now, another basket that we have is the brand value basket. Now, this is what we call a thematic small case. The brand value basket consists of companies that have a strong brand power. For instance, I can give you one example. Titan is one such company which we believe has strong brand power. Anybody who thinks of watches, or anybody who thinks of, like, going to a showroom and buying jewelry, Titan is one of the first names that comes to mind. Very similarly, if somebody is thinking of, let's say, buying a car or an SUV within a car, then Mahindra is one of the first names that comes to mind. So this particular small case consists of companies that have been able to leverage their brand power into an outstanding track record over the years. So Titan is one such company. I think this quarter, if you look at their September 2023 quarter, I think this is if my memory serves me right, this is the 10th straight quarter of revenue growth or something for the company, which means in spite of all sorts of slowdowns and inflation and all of these factors, they have been able to leverage their brand name to deliver extraordinary financial performance, right? And that is seen in the performance of the stock price of that company also. So usually, because we are talking about strong brands, we are talking about large cap companies, the volatility tends to be on the medium size, and the annual subscription fees is about 6,000 rupees. Another extremely interesting and one of our most popular small cases is the all-weather investing small case. Now, this small case consists of 3 different ETFs, which gives you access to equities, debt, gold, and gold. Sorry. So those are the 3 asset classes: equity, debt, and gold. So what we do is we take a look at what is happening to the volatility in the market, and depending on market volatility, we keep switching the weight of the different asset class. If we feel the market is going to be volatile going forward, we move all your money, or the weightage of debt and gold starts going up. If we feel the market is not going to be volatile, we give a lot more weightage to equities, which is why your the weightage of equity ETF within that basket goes up. So what this is one basket that we have seen. This is a this basket works across all market condition, and anybody interested in investing in the stock markets can invest in it. So there's essentially, when it comes to investing, there's something called a core and a satellite investing strategy. So a core strategy, it is said that a core portfolio should consist of all asset classes, and it should be able to give you consistent returns regardless of market conditions. Once you have built up your core portfolio, you should then cover it with your satellite strategies, like the ones like value and momentum, or dividend stars or whatever, which will perform very well during market uptrends, maybe not perform so well during market downtrends, right? So this is what core satellite investing approach usually tends to mean. And all-weather investing is a perfect basket if you try to implement the core satellite investing strategy. It consists of 3 different asset classes, just to wrap up the discussion. And based on volatility, we increase weightage to different asset classes. During high volatile periods, we increase weightage to debt and gold, so that there is not too much of downside in the basket. And during low volatile periods, we increase the weightage to equity, so that whatever is the uptrend in equities can be captured within the performance of all-weather investing. So this is a free access small case that you can all go ahead and explore. So that sort of brings me to the end of what is small case and all of these things. So in conclusion, if you look at small cap companies, there are more than 800 companies with market capitalization greater than 1,000 crore rupees. So that is a large universe. If investors are interested in investing in small cap companies, that is a large universe that you can explore. And this universe has a significant potential for growth and price appreciation in the years ahead, right? As India moves up the chain and we become bigger and bigger economy, these 800 companies are the ones which are going to perform exceptionally well over the next decade or 2 decades. So by investing in these small cap stocks, what investors can do is they can seize this opportunity early on with emerging companies, right? There are definitely going to be periods during which where it is going to be stagnant. Like I told you, during the Russia-Ukraine war, for almost 1 year, the small cap stocks did not do anything. But then subsequently, when the performance picked up, you can see that small cap stocks have significantly outperformed large cap stocks. So investors who are going to who are sort of ready to take that risk, if you want to invest in the next Infosys or Titan or TCS or Adani or Reliance or any other company, you should definitely look at the small cap universe of stocks. Now, what is the windmill advantage? You have a carefully curated portfolio, and if you can go onto our website and take a look at it, you can see the historical performance. All of these small cases that I have talked about, they've been around for more than 6-7 years, which means they have carried their performance across different market cycles. And then on top of that, you have like regular rebalancing and everything that allows you to access a diversified and balanced portfolio. On top of that, if you are investing in any paid small case, you obviously have access to the manager. There are monthly AMA sessions, that is Ask the Manager Anything sessions that we conduct, where you can directly get in touch with the manager to talk to him about what the small case is doing, or if there are any other doubts around your investments in windmill capital small cases, you can definitely discuss that. We will give you regular updates once every month. We will send out a newsletter. We spend a lot of time and effort in putting together that newsletter, wherein we are discussing the performance of different small cases, as well as any topic that should be of interest to the investor, right? So there are all of these advantages to investing in the fee small case of windmill capital, right? So just to wrap up the entire discussion, windmill capital builds low cost and transparent thematic as well as quantamental basket small cases for you. Thematic, one example of a thematic small case is the brand value small case that I was talking about. Quantamental small cases are your dividend stars, AWI, all of these are quantamental baskets, right? They are based on a quantamental framework. There is a quantity fundamental aspect to the basket, as well as a quantitative approach also that we are taking to creating that particular basket. So Windmill Capital is a SEBI registered research analyst. You can go on to SEBI's website and confirm. You can just type out Windmill Capital and you'll be able to see our registration number and stuff. In fact, we have put out our registration number here. We are based out of Bangalore. We are a subsidiary of Small Case Technologies. And this is a little bit about quantamental investing framework. So how it works out. We start with idea sourcing. So for instance, if I have to give you an example, value and momentum, right? first thing that we have to understand is whether these factors work together. The idea is like, okay, what happens when I invest in low value stocks that is, that is seeing price momentum? That is my idea. Then I have to do a little bit of research to understand whether historically, whether this approach or this idea has been tried out anywhere, what has happened in that particular market. Are there any research papers available that I can read through? If I do it in an Indian context, how exactly would I do it? What is my, backtesting period going to be? Since I'm looking at momentum investing, what is the time period during which I'm going to rebalance? We have to think about all of these things. Then we have to think about a universe on which we are going to apply. Now, the quality small cap smart beta is only applied on a small cap basket, right? Very similarly, the value and momentum, we will apply it only on the top 700 companies listed on the on NSE. Then we have to come up with an appropriate fundamental screener and finalize the quantamental model that we are sort of creating, which means like, the exact criteria. What is the level of PE that I'm going to be comfortable with? Should I be looking at PE of 25? Should I be looking at PE of 20? Should I be looking at PE of 15? What is the momentum time period that I'm looking at? Is 1 year momentum good enough? Is like a 6-month momentum good enough? When we are discussing momentum, what is like, my relative comparison? Should I be comparing it against other small cap companies? Should I be comparing it against the market, which I will define as Nifty 500? All of these aspects. And once all of this is like sort of finalized, we create the basket and we make it available. And once every quarter or whatever is the time period for that particular small case, we go ahead and rebalance it to ensure that the stocks and their corresponding weightage remains fresh within that basket. So this is how a quantamental investing framework works. I think that sort of brings me to the end of our discussion. If you have any questions, we can sort of take it.
Hello, Naveen. Thank you for this insightful session. We have a few questions from our viewers.
Mm-hmm.
So the first question is from Nishant. He's asking, with markets being at an all-time high, is it still a good opportunity to invest right now?
Like I told you, there are two aspects to it. Market being all-time high. Market will be at an all-time high some point or the other. The question is, what are the circumstances under which market is reaching a high? Like I told you, during the Russia-Ukraine crisis, for almost 1.5 years, we saw that the markets underperformed, right? It was very, very flat. And then subsequently, because of all this story around, India's growth and all of these things, the markets have started trending up. And that trending up, there is a solid basis to it. It is not just fluff there is to it, right? There is India's economy growing at the fastest pace when compared to any other large economy. Plus, valuation comfort is what is contributing to markets growing. So if you ask me, is it a good time to invest? Yes, absolutely.
Thank you so much. I hope it answers Nishant's question. Next, we have a question from Chinmay. He is asking, what are the risks associated with small cap stocks or portfolios?
Obviously, the biggest risk is that it is a small cap company. So small cap companies themselves don't have the wherewithal to, their business models tend to be not so well defined when compared to that of large cap companies, because of which when the economy tends to underperform, these guys tend to take a greater hit. Their margins, their growth is under pressure. Their margins are under pressure. They probably don't have the best, management systems. They probably don't have the best corporate governance practices and stuff like that. So these are some of the risks associated with the company. Now, all of these, risks sort of translates into price performance, which is why when there is a market downtrend, the downtrend is sharper for small cap companies as compared to mid-cap companies, right? Which is why my suggestion is, if you are keen on investing in small cap stocks, and there is a large universe of small cap stocks, I just showed you there are more than 800 companies. If you're keen on investing in small cap stocks, my suggestion is, I'm not going to say always go ahead and buy windmill capital small cases, but look for a portfolio approach from a competent investment manager.
Thank you. Next, Anil is asking, small caps when held longer will attract long-term capital gains tax. How can this be avoided?
Well, you cannot avoid the tax aspect of it, but if you are going to hold on to quality small cap stocks over the long period of time, they give you exceptional amount of return. So the tax part of it should not pinch you so much. Tax you're going to pay whether it is a small cap stock or a large cap stock. If you hold equity investments for a long period of time, you're going to pay the tax aspect of it. So that that's not something that you can avoid. But obviously, if you make higher returns, it's not going to pinch you as much, right? Let's assume you make 100%, 100 rupees gain, and out of that you have to pay 10 rupees. You're just left with 90 rupees, right? If you're doing, instead of that, if you're doing 1,000 rupees and you still have to pay let's say 50 rupees, you are still left with 950 rupees. So the proportion is greater when it comes to small cap stocks.
Thank you. Next, we have a question. Can you please elaborate on the cost aspect of each plan?
So like I told you, let me just take you back here. As far as quality small cap smart beta is concerned, I think the 3-month plan is going to cost you about 3,000 rupees. Value and momentum is also the same, about 3,000 rupees for a 3-month subscription. Dividend stars are slightly cheaper. It is 2,000 rupees for a 3-month time period. Cancel risk is 3,000 rupees for 3-month time period. Low risk smart beta, I can't exactly recall what is the quarterly fees, but the annual fees is 4,500 rupees, which means it is comparatively cheaper when compared to the other small cases that I showed you. Brand value small case is 6,000 rupees for an annual subscription, so about 2,000 rupees for a 3-month subscription. All weather investing is free to access. Windmill Capital is not going to charge you any money when it comes to investing in small case. Obviously, when you're buying and selling from your broker account, there are going to be some statutory charges associated with it. And small case is going to charge you some transaction fees because you're using their platform. Outside of that, there is no charge. If you want a little more about charges and stuff like that, you can write to us at support@windmill.capital. We'll be more than happy to share detailed information of what all charges you might incur by investing in specific kinds of small cases. The email ID that you can reach us on is support@windmill.capital.
Next question is, what percentage of my capital should I divide in small cap and large cap portfolios?
That's a very difficult question to answer. So a couple of things have to be taken into consideration. One, what is your, what age you are? What is how much time do you have left for retirement? What is your risk-taking potential? And all of these aspects come into picture. So if you are a young person with a lot of saving for your retirement, and you have the ability to take a lot of risk, my suggestion is up to 50% or 60% of your equity investment can go into small caps. If that is not the case, if you are in your mid 40s or early 50s and you are looking to retire in the next few years time period, then probably not more than 10% of your equity basket should be in small cap stocks. So the question has to be customized based on one's age, one's risk-taking ability, the amount of money that is getting invested in equities, and all of these aspects. My suggestion is sit down with a financial planner to get a good understanding of this. Because it has to be, the allocation has to be customized based on all of these factors.
Yeah. And we have a final question. What is the right time to invest in small stocks, or is there a right time, or is it an all-weather investing?
It is an all. You should always go out and keep investing with any equity investment for that matter, not just small caps or mid caps or large cap stocks. Investment discipline is the absolute most important thing that will ensure that you make good returns, whether regardless of whatever is the type of stock that you're investing in. So there is no good time or bad time to invest in. If you have started investing in a competent small cap company or a competent small cap basket, then regardless of the market situation, kindly continue with your investment. That way, what will happen is, if you're confident about the fund manager's performance, you'll be able to, there are going to be times when the basket is going to fall or it is going to be flattish for long periods of time. What will happen is you will be able to average down your cost, and when the market improves, the performance or the returns on that average down investment will be very, very huge, thereby pushing up your overall performance. I hope that answers the question.
Yeah. Thank you. Thank you so much for this session, Naveen. All the questions have been answered, and I hope it is clear to our viewers. Thank you for this session.
Thanks, Shrikant.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.